Hello friends, welcome to another session of ACE Accounting Exam Series. So today is the part 3 of the accounting ratios topic. So in today's session, we are going to be doing one important ratio where normally students find difficulty, and that is the interest coverage ratio. So in the interest coverage ratio, we need to first know the formula. So once you know the formula, you will have to use this data and calculate. So let us first read this question and understand the details given to us. From the following details obtained from the financial statements of GE Limited, calculate interest coverage ratio. Net profit after tax. So mind it is after tax. The net profit was 1,20,000. 12% long-term debt was 20 lakh. So this 12% represents the interest that is to be paid to this on this particular long-term debt of 20 lakh. And there is a tax rate of 40% that is to be charged. So now note down these details, and then as we move forward, you will know how to calculate the interest coverage ratio. So let's go. First, we will learn the interest coverage ratio formula. The formula here is net profit before interest and tax divided by interest on long-term debt. So if you remember from the data, what was the net profit given? It was net profit after tax. Means from this net profit, interest has been subtracted and tax also has been subtracted, and that amount is net profit after tax which has been given the question. So please do not directly substitute that net profit here. We will have to work out this amount with the available data. And interest on long-term debt would be that particular percentage I highlighted, 12% will be calculated on that long-term debt, which was 20 lakh. That interest would be taken here. So now that you have clarity of this formula, let's go and solve the question. Let us just note down the details once again in this slide. It is net profit after tax, which was given as rupees 1,20,000. They gave us that there was 12% long-term debts, which was worth 20 lakhs, and they said the tax rate was 40%. Now we know the interest coverage ratio formula. What was the interest coverage ratio formula? It was net profit before interest and tax by interest on long-term debts. So we will calculate first the numerator. Now what are we supposed to calculate? Net profit before interest and tax. So we are going to start with the net profit after tax which is available. Now you should know, to calculate this, first you need to know what is the step by step how you arrive at net profit after tax. So let's understand that concept. Actually first what you have is net profit before interest and tax. From that we subtract first the interest, which is an item of charge, and then we arrive at net profit before tax, and from that we would be subtracting the tax to arrive at net profit after tax. So we will take it here. Suppose we take the net profit before tax as 100. Then what is tax? It is at the rate of 40%. So at the rate of 40%, 40% of 100 would be 40. So we subtracted. What do we get the net profit after tax as? 60. So now what is the data available to us? We have this net profit after tax as 1,20,000. So this is available to us. This amount has been given. But what do we need? We need to arrive at this. So how do we calculate? We will slowly go back to arrive at the net profit before interest and tax. First, what we will do is we will equate this. We know the 60 number is represented by 1,20,000. What do we need? The net profit before tax, that is 100. So what is 100 equal to? 100 into 1,20,000, there's cross multiplication, divided by 60. So when we do this, you get rupees 2 lakh. So we arrived at what? This is the net profit before tax. There's one more thing to be adjusted. That is the interest. So we will have to calculate the interest on long-term debt, which is at the rate of 12% on 20 lakh. So 12% of 20 lakhs would be how much? 2,40,000. So now that we have got this, what would be the net profit before interest and tax? We have net profit before tax 2 lakh. To that we add back the interest. So 2 lakh plus 2,40,000 would be the net profit before interest and tax. I will write it here. Net profit before interest and tax would be the net profit before tax, that is 2 lakh, plus the interest, which is 2,40,000. So that comes to 4,40,000. So we write at the numerator 4,40,000. Divided by interest on long-term debt, we have 2,40,000. And that's it. We are done. We find out, and that is in times. So it comes to 1.833 times. So this is how you calculate. You need to understand this concept, work back and get to this amount of net profit before interest and tax. Please don't in a hurry take this amount as a numerator. So I hope it is clear to you now. And moving on, let's go to one more question. Here also you are supposed to calculate interest coverage ratio. What is given? Net profit after interest and tax. The same way they have given us net profit after interest and tax 1,20,000. Rate of income tax is 40%. But here we have 15% debentures, rupees 1 lakh, and 12% mortgage loan 1 lakh. So there are two long-term debt items available. We'll have to calculate interest for both of them, added together. That would be the total interest. Okay. So the same way we'll have to work back and then arrive at the required information. So let's go. Let's write down the detail again once more for ease. Net profit they have given after interest and tax. That was given as rupees 1,20,000. They've given the tax rate as 40%. And they've given us that there were 15% debentures, which was rupees 1 lakh, and there was 12% mortgage loan, that is rupees 1 lakh. So now with this information, let's start. Interest coverage ratio formula is net profit before interest and tax divided by interest on long-term debt. Here we have two items of long-term debt. Now let's calculate again here. What are we supposed to calculate? Before interest and tax. And what do we have? Net profit after interest and tax. So same way we will calculate. We know that net profit after interest and tax was 60. And the net profit before tax would be then 100. As per the explanation, please go back and review it. If you're not yet clear with that, learn it again and come back here. I'm not repeating it again here. So we know 60 is represented by 1,20,000 rupees. So we want to find out what is 100, and we get it as rupees 1,20,000 into 100 divided by 60, which we adjust in previous. The same numbers have been used. 2 lakh rupees. So we got net profit before tax. That is what is 2 lakh rupees. Now we will have to calculate the interest. Interest, there are two items. One is 15% debentures, which is 15% of 1 lakh. That would be how much? 15,000. And then there is 12% mortgage loan. So 12% of the loan amount was 1 lakh again. So you get it as 12,000. Therefore, what is the total interest? 27,000 rupees. So now this was net profit before tax. This is the interest. So what would be the net profit before interest and tax? It would be this 2 lakh, that is net profit before tax, plus interest 27,000. So that is 2,27,000. So we got the numerator here 2,27,000. And the interest we have to take entire 27,000. And that's it. You find out the amount. It comes to 8.4 times. So from this, we know how to now calculate interest coverage ratio. I hope this session was useful to you. So if you like the video, please like it, and if you have not yet subscribed to the channel, please subscribe to the channel and continue watching. There will be more upcoming videos on this A's accounting series on other topics too. Thank you.